Today, we're jumping into two of the absolute heavyweights of options trading for income: covered calls and cash secured puts. Now, they're staples for a very good reason, but they're also hiding this really fascinating secret. And honestly, it might just change how you think about them forever.
At first glance, you'd think this is a no-brainer. The line between them seems crystal clear, right? They look like they're for two totally different people. One investor already has the stock and wants to make some money off it, while the other is sitting on cash, looking for a good time to buy.
All right, so let's do a super quick refresher on the covered call. The setup is simple. You own at least 100 shares of a stock. Then you sell a call option. And for doing that, you get paid a little bit of cash right up front. That's the premium. It's kind of like renting out your stock. But here's the catch. In exchange for that cash, you're now obligated to sell your shares at an agreed upon price, the strike price, if the stock price shoots up.
Now, let's slip over to the cash secured put. With this one, you find a stock you'd really like to own, but maybe you think the price is a little high right now. So you sell a put option and you set aside enough cash to actually buy 100 shares at a lower price. And for doing this, you collect a premium. You're basically getting paid to set a buy order. Your obligation? It's the complete mirror image. You have to buy the shares at that strike price if the stock drops below it.
Okay, let's get into it, because this is where the simple explanations stop and things get really interesting. We've just laid out two strategies that seem like total opposites, right? One is an obligation to sell, the other is an obligation to buy. But what if I told you they have a secret identity?
I know it sounds totally crazy. An obligation to sell being the same as an obligation to buy? How is that even possible? Well, from a pure risk and reward perspective, when you set them up in a specific way, these two strategies are mathematically identical. They are what we call synthetic equivalents.
The key that unlocks this whole mystery is a fundamental rule in finance called put-call parity. Think of it like a law of physics for options. It's this non-negotiable relationship that proves a covered call position, that is, owning the stock and selling a call, has the exact same risk profile as a cash-secured put. It's the mathematical proof of their secret identity.
Check this out. This chart just lays it all out perfectly. When you graph their profit and loss, the shapes are perfect copies of each other. The formulas for max profit, max loss, and your break-even point, they're all functionally identical. The math does not lie. From a risk perspective, they are the exact same trade.
So, if they're identical twins on paper, why do we even bother choosing? Why isn't one of them just obsolete? Well, because the real world isn't a perfect theoretical model. When these strategies come off the page and into your brokerage account, they collide with real-world frictions that make them very, very different tools. The first, and you could argue the biggest difference, is how much of your money they tie up. A covered call forces you to own the stock, and that's a huge chunk of capital. But a cash-secured put, especially if you have a margin account, might only require you to set aside a fraction of the total cost. And what that means is your return on the actual capital you have at risk can be dramatically higher, sometimes even double. That makes it a way more capital-efficient choice. Dividends are another major fork in the road. As the stock owner, the covered call writer gets that dividend paid directly into their account as cash. But there's a risk. The person who bought your call might exercise it early, right before the ex-dividend date, just so they can grab the dividend instead of you. The put writer, on the other hand, doesn't get the dividend check, but they get compensated for it upfront with a bigger premium, and they have zero risk of that early assignment nonsense. And then we get to taxes. Oh boy, this is a really big one. Think about what happens when you get assigned. For a covered call, assignment means you are forced to sell your stock. That sale is a taxable event. And if you've been holding that stock for a while, it could trigger a nasty capital gains tax bill. But a put assignment, well, that's a purchase. It is not a taxable event. It just sets your cost basis for your new shares. This is a massive, massive strategic advantage for the put. So let's pull all these practical differences together. When you line them up, a pretty clear picture starts to emerge, doesn't it? The cash-secured put often has the edge for an active trader. It's more efficient with your capital, it can be cheaper to trade, and it's way, way better from a tax standpoint. Really, the main place the covered call wins is just simplicity and access. It's the one that almost any basic brokerage account can get approved for. But the divergence isn't just about the mechanics of money and taxes. It's about something way less rational, our own psychology. The reason these identical trades feel so different is because of the stories we tell ourselves about them.
This is the power of what's called the framing effect. A covered call is framed as this conservative, prudent thing to do. You're just enhancing the yield on something you already own. It feels safe. But selling a put, that's often framed as selling insurance or taking on a risky obligation. The language itself makes it sound speculative and dangerous, even though we know the risk is exactly the same. And this quote from an investor, wow, it just gets right to the heart of it. This is all about loss aversion. When a stock falls, managing a losing covered call feels like you're salvaging value. You're selling at a reduced loss. But managing a losing put feels like you're actively taking cash out of your pocket to pay for a mistake. One feels like a smart recovery, the other feels painful, even if the financial hit is identical.
Okay, so we've got the theory that says they're twins, the practical reality that says they're different, and the psychological split that makes them feel different. So how do we turn all of this into a clear, usable framework? Let's put this all together so you can pick the right tool for the job. One of the most popular ways to combine them is a strategy that's literally called the wheel. It's a really elegant system that uses the strengths of both. You start by selling puts, getting paid while you wait to buy a stock you like. If you get assigned, great. Now you own the shares. So you immediately start selling covered calls against them for more income. And if those shares get called away, you're back to cash and you start the whole cycle over again. It's beautiful.
But hey, even if you're not running the wheel, you can use this simple chart as your guide. If your only goal is to make some income on stock you already own and plan to hold, the covered call is the most direct path. But if your goal is to buy a stock at a discount, or you really want to maximize your capital and tax efficiency, the cash-secured put is almost always the superior tool. And of course, if you're in a basic retirement account that doesn't allow put selling, well, the choice is made for you.
So in the end, we're left with this fascinating paradox. The theory proves they are two sides of the very same coin. But the real world, with its frictions like taxes, capital requirements, and even our own brains, forces us to choose a side. Which one you pick depends entirely on your goals, your account, and your own temperament. So that leaves us with one last question to think about. Now that you know the difference, which one is right for your portfolio?
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.